All right. Well, good morning or good afternoon. Good day, everybody. Thanks for joining me for my weekly market update. Appreciate y'all joining in. Those of you who are watching me through Zoom, please comment on Zoom chat any questions you might have as we are presenting today. If you're joining me on Facebook, then put the comments into Facebook. I'll try and pay attention to Facebook, but it's only in the corner of my eye, so I don't see all those comments right away, and I might get back to those later. But let's go ahead and dive right in. As I've been doing since the pandemic really started back in the middle of March, I'm giving you guys a weekly update on what's going on in the mortgage market and things that you need to know to keep you sharp with your buyers and your sellers and kind of what's going on in the big picture of the market. So I've trimmed these down to no more than 30 minutes now, once a week, and really giving you the most important snapshots on what you need to know. So let's go ahead and dive in and get started. So this week, I'm going to focus on a few very simple things. I'm going to give you a rate update, as I do every single week. I'm skipping the forbearance update, but I'll tell you real quick, forbearances are pretty steady. They haven't been really going up or down over the last week. The thing that I'm reading about is some of the numbers on delinquencies are starting to increase, and that is concerning. I don't know why we'd have a bunch of people going delinquent that aren't in forbearance, and that's a strange anomaly because people have the opportunity to go into forbearance right now. There's no good reason for them to be delinquent on their mortgage. But the numbers show that 90-day delinquencies are up pretty significantly. And so that is going to be interesting how that plays out. But bottom line is the market itself for the forbearance is holding strong. And it should be kind of contracting right now. We're right at the place where the first 90 days of being, I've got people who are on audio. Let's see, here we go. All right, so we've got people who are in the first 90 days of forbearance, and they're starting to wrap that up. A lot of people, more and more articles are coming out about people that were put into forbearance that didn't know it. Wells Fargo got thrown under the bus with a pretty major article on that same fact. I think they're getting a little more negative press than they deserve on that because they simply did what the government forced us all to do, which is to accept people. If they said they wanted a forbearance, then you had to give it to them. The problem is maybe they didn't word it very carefully on that, hey, when you click this button, it means you're getting a forbearance instead of you're just looking for information about what it means to be in forbearance. So that's where we stand on the forbearance front. I'm going to give you a real good snapshot into sample rates. This is a follow-up of my conversation last week about kind of how low rates can go. And I'm going to show you what I mean when I say a coupon opens up. We actually saw that happen over the last few days, and it was you'll see that on the rate sheet. And then I'm going to talk to you about using down payment assistance to cover short appraisals. I had one that's closing this week that was exactly this situation. The buyer was really aggressive in writing an offer on the property. The value came in short, and the seller was not willing to budge. And I put my thinking cap on, and I tried to figure out a way that we could bridge the gap, and down payment assistance was the solution. And so I want to share that with you as a tool to help bridge that gap, because we all know right now, more and more, we're going to run into those situations where you've got an aggressive market and you've got buyers that just have to be aggressive in order to get their offer accepted. And sellers are not as inclined to say, okay, I'll lower my price now. They're more inclined to say, well, then I'll wait for somebody else who's going to offer me that price. And the buyer loses out. So I'm going to show you how we can make that work for you. I'm going to leave a little time for Q&A. So let's dive in. First of all, as I talk about every week, give you a snapshot on kind of how volatile the rate market is. Remember, this chart is inverted. In other words, up is good for interest rates, down is bad for interest rates. But remember, this is what we call the secondary market. So the primary market is the rate that I'm going to show you in a minute, which is the rate that your home buyers get when they lock in an interest rate with me. That's subliminal messaging, by the way. Your home buyers locking in an interest rate with me. If you didn't get that, I'll repeat it again before the end of the call. So the fact is that that's the primary market rate that your home buyers are getting when they lock in an interest rate with me. The secondary rate is what we are paying to Fannie Mae, to Wall Street, basically what the mortgage-backed securities value is.
Got to join it.
And I want to remind you, there is a really, really big disconnect still between what we are having to pay on our end. Our cost of funds continues to be very, very low. And as an industry, we're not passing that along because we can't afford to open the floodgates. There are too many people who are trying to do loans right now. And as an industry, if we let all of those people get the interest rates as low as they should be, we'd be completely inundated and the system would collapse. And so as any basic supply and demand says, the more demand there is for your product, the higher you're going to raise the price because you only have so much capacity. And that's what's happening in the mortgage industry. We're still continuing to see stability overall. We're seeing rates as better, and you'll see in just a second, because I'll show you the live rate sheet for today. You're seeing the Fed continue to be the biggest buyer of mortgage-backed securities. We expect it to be that way. So my advice has not changed in the last 4 months. If you're purchasing, lock it right away, because you can't afford to worry about this short-term volatility. But if you're refinancing, float your loan. It's a horrible idea to lock an interest rate at the beginning of the loan process when you're refinancing. Wait until you get to the end of the process and then lock it in. You're locking for a shorter period of time. Why buy insurance against rates going up when the truth is we expect rates to stay the same or go down? All right, so let's look at some real rates on what I would call the primary market. So this is today's rates. I'm going to start with a 30-year fixed conventional loan. What you're seeing here, and I always explain this to your clients, so when you refer your buyers to me, again, another subliminal message. It's not so subliminal if I say it out loud, is it? But I'm going to keep saying it anyway. So when you refer your buyers to me, I show them all this screen so that they can fully understand it. And I realized I don't show my partners the screen anywhere near as often as I show your buyers. This is the raw market. This has all of the adjustments built in based upon their credit score, based upon their down payment percentage. This is a 25% down payment on a 740 or better credit score, and this is today's numbers. Now, this is based on a 21-day lock. That's where I talked about the fact that the shorter you lock, the better your rate is. If you go 30, 45, or 60 days on the lock, the rates get a lot more expensive. So your short-term locks are significantly more advantageous. But as I explained to your buyers when you refer them to me, is you can pick any rate you want, and you just have to pay the accompanying fee that goes with it. So which interest rate do you choose? And everybody says, well, I want the cheapest one, John. And I said, that's great. But that means you have to spend an extra $6,000 or almost 2% of your loan amount in fee buying down that interest rate. Is that really worth it when the next tier is only an increase of $22 a month, but it saves you over $2,000 up front? Quick math says that takes 100 payments to make back your money. 100 payments, most people sell or refinance their home in around 5 years. So if you can't make back the money in the first 60 payments, it's typically not worth doing. So 2.625 doesn't make sense. Here you can save another $2,000, almost $1,800. Again, the law of diminishing returns. So at a certain point, you get less bang for your buck, and it only costs you, again, $22 more. Here you're saving about $1,700. But at the next tiers, you don't save anywhere near as much money. So the sweet spot right now is right here at 2.99. You're paying almost no points. Think about that for a second. A 30-year fixed conventional loan, almost 0 points. If you wanted to pay a point, you can get around 2.75. I don't know that it's worth it for only saving about 0.25% off of the interest rate, but that's for your clients and I to decide together. But the sweet spot for me is 2.99. Guys, these are the best rates I've ever seen. If you remember when I started this webinar back in early March, I said that March, I'm thinking of the days, March 9th, that Monday was the best rate day I had ever seen, and the next day it shot up. So the Friday before that, rates were at around 3.25, paying 1 point. That Monday, we were at 2.99, paying a point. And those were the best rates I had ever seen, and then they went back up to 3.25, paying a point. We're at 2.75 right now, paying a point. We are significantly better than that amazing Monday that I talked about in March. Rates are amazing, and they're staying at this level. And the scary thing is they should be lower. But as you can see, if we pass on that much lower of an interest rate, we're going to open up the floodgates even more. And as an industry, we just don't have the capacity to handle that. But let me show you, by the way, you stop at 2.625 because that really is the 2.25, or the 2.5% coupon. The lowest we have to stay at least 2.625. So we're really not selling into the 2% coupon very much right now. And that's where coupons come into play. And I'll show you on the next screen. For a 15-year fixed rate, we just opened up that lower coupon. We can now go as low as a 2% interest rate for a 15-year fixed rate loan. Now today that's costing almost 2.5 points. So is it worth buying yourself down to 2%? Well, if you want to have the bragging rights of saying you're at 2%, cool. We can probably even round it down to 1.99 so you can say you got a fixed rate in the ones. The last time somebody said they got a rate in the ones was a pick-a-pay loan back in 2005, and they had no clue what they were getting. So at least now they're getting an actual fixed rate that is in the ones, and it can be done. You're definitely paying for it today. So that's where time comes into play, that I think as the market continues to evolve, we're going to see the rates still be able to be this low for a 15-year, but these costs are going to start coming down. But did you notice that with just 1 point, you can get 2.375 on a 15-year loan? That is crazy, crazy low interest rates. And with a 1/4 point, you're at 2.625. So these rates are super, super good. Just remember, the market is not rewarding higher rates with covering fees on your behalf. I've talked about this a couple times over the last 3 or 4 months, but as you notice, to get any kind of a credit towards your fees, you've got to go way up in interest rate. Like from 2.5% to 3.5%, you're paying an extra 1% per year, and we're only increasing your upfront or decreasing your upfront cost by 1.5%. That's pretty silly for you to raise your rate by 1% every year simply to save 1.5% upfront, because you wouldn't have to pay this 0.5%. I'm rounding a bit, but you would get a credit of 1%. So the market is not having an appetite for you getting credits when you have a higher interest rate. And the reason is simple, because the market is concerned that rates are going to continue going lower, and they are not going to pay all of these fees up front for a higher interest rate, because if rates drop a little bit further, you're going to be really eager to refinance that loan and get a significantly lower rate down the road. So just be aware and make sure your buyers are aware. Rates are super, super good, but the market is fickle, and it's not absorbing the cost. If you wanted a no-cost loan, or if you had a high-risk loan because it's an investment property or a multi-unit property, the market's not absorbing that as easily as it had been in the past. Now let's take a look at FHA. Guys, I was shocked when I looked at this. FHA, 30-year fixed rates, 2.25% with less than 1.5 points. FHA 30-year fixed, 2.25% with less than 1.5 points. This is absolutely the best interest rates I have ever seen in my entire career. I was super excited a couple months ago when we were under 3% on an FHA 30-year fixed paying a point. Now, what you'll notice is there's a huge drop off right here, 2.75, and you pay no points. You want to get to that next coupon level, 2.625, you got a huge jump in fee. So the sweet spot on an FHA loan is 2.75 paying no points. But that, and again, that's on a 21-day lock. You can definitely buy it down further, and you see once you get to 2.625, it's only a hop, skip, and a jump, a little bit more fee to get to 2.5, a little bit more to 2.375, and a little bit more to 2.25, because all of these rates are in one coupon. And so they're all around the same cost. They're just a minor amount more or less expensive. But this is the cutoff. The Mason-Dixon line is right here, where everything below this is in the next coupon. And we talked about coupons before. I'm not going to go too deep into it, but I want to give you some hard numbers to wrap your head around. We literally have FHA 30-year fixed rates below 2.5. Paying 1 point, you're at a 2.5% interest rate. Very, very aggressive interest rates. A great time to be a homeowner, a great time to be buying. And if you're, and as a reminder, I've said this a few times in the past, these are definitely the times to think about love it or list it. Call your database. If you are not in contact with your database, you are missing out on a goldmine opportunity. When you call your database, it's a simple conversation about how's the home? Do you love it? Is this the right home for you for the next 5 years? If not, now is the time to sell it, because you can sell your home right now. It is an awesome opportunity with as much appetite as there is for buyers looking for homes right now, and you can get an interest rate half of what you would have paid a year ago. Think about that. A year ago, rates were in the mid to high 4% range. Right now, they're in the low 2% range in some circumstances. Absolutely unheard of. By the way, VA rates are the same as FHA. So you've got a VA buyer, we're at 2.5% paying 1 point, 2.25% paying 1.5 points. Super, super good interest rates. Again, an amazing time to be a homeowner or a home buyer. All right, any questions about interest rates or anything that I've talked about, please feel free to post in Zoom comments if you're in Zoom. If you're in Facebook, post in Facebook comments. Again, I don't track the Facebook comments as much as I track the Zoom comments. But bottom line and where we're at with interest rates. So now, oops, I forgot to update this slide. Anyway, it doesn't matter because this slide really has to do with, and I want to talk about the down payment assistance piece. And that is wrong slide again. Hold on. Hold, please. Is it this one? It's this one. All right, I'm there. All right, so this is what we're looking at, by the way, is what we call our total cost analysis. This is a breakdown that I will send to your buyers when you refer them to me to get pre-approved to purchase a home. Has anybody kept track of how many times I've said that? Because I have like 3 more times I need to say it before the end of this call. All right, so this is a total cost analysis. It breaks down their cost of the loan and all of their options. And so I'll be able to show somebody very clearly what their loan choices are. And so what we see right here, this first scenario is, hey, the house is listed for 450 and your buyer offered 480 because they are tired of losing out on their offers. They want to win that offer and they're going to make the offer at $480,000. But they hope and expect the value is going to come in at 480. So we're looking at a 30-year fixed. I just ballparked an interest rate of 2.875. This is an FHA loan. Again, I think 2.75 was probably the sweet spot. But we're at 2.875 on a 30-year fixed FHA loan in this scenario. Payments $2,900 a month, and they're coming in with about $31,000 out of pocket. But lo and behold, the appraisal comes in $10,000 low. Now, the seller doesn't agree to lower the price. So the buyer still has to pay $480,000 for the home, but now their loan amount is got to be dropped by $10,000. Well, in that scenario, it's awesome. They're going to save about $50 a month on their monthly payment, but they're coming in with an extra $10,000 out of pocket. And that obviously is the scary moment for buyers, especially if they're going in aggressive on purchase price. And a lot of sellers are asking for removal of appraisal contingency, which even worsens that fear. So this scenario gives you kind of a backup plan. So what I'm looking at here is our 3% grant program. So this program is a forgivable loan. So this loan basically is a second mortgage that you do not have to be a first-time home buyer to get. You do not have to meet any income thresholds. Those are the 2 things that when I said, hey, let's use down payment assistance to solve this problem, you probably said, John, you can't. Because you have to be a first-time home buyer to use down payment assistance, and you have to meet certain income thresholds. You can't make more than a certain amount of income to use down payment assistance. Those days are over. Almost all of my down payment assistance programs have no income threshold at all. Almost all of my down payment assistance programs have 0 requirement to be a first-time home buyer. So in this situation, we're giving them a 3% grant. Now I call it a grant. It's a forgivable loan. So if they take out this mortgage, they get a second mortgage for 3% of the purchase price. And that second mortgage is forgiven in 1/3 increments for the first 3 years. So at the end of 12 months, they only owe 2/3. At the end of 24 months, they only owe 1/3. At the end of 36 months, that second mortgage is completely forgiven. They never have to pay it back. Now, the fee is a little bit higher. You're actually paying 1% more in fee than what you would normally pay. So the truth is you're only gaining about 2% in your pocket of additional funds when you get a 3% grant. But that's all you really need. Because on this almost $500,000 purchase price, we pick up 2%. We're picking up almost the $10,000 that we were short. Now the buyer's coming in with $31,000 instead of the $30,000. Again, it's only about $500 more out of pocket. In this scenario, the payment was actually a little bit cheaper because the interest rate, guys, think about this. On an FHA loan, we're giving you a 3% grant, forgivable loan, and the rate is 2.75%. And that's with me giving you 3% as a forgivable grant. Forgivable loan, forgiven after 3 years. The attorney was going to kill me if I don't say the right terminology. It is not a grant from the beginning. By the way, I have 3 different down payment assistance programs. This is just one of them. So this is one way that we make this work. There are multiple ways that I can make this work, but this one's my favorite right now because the money is forgivable and they're really, really super aggressive at how much money they're giving you relative to what the interest rate is. So this is a really, really good tool. The other option is a 4% grant. Now that interest rate's a little bit higher. It's about 3% instead of 2.75 as of today, but now you pick up an extra 1% of forgivable funds. Now you're actually coming in with less money out of pocket. So you're coming in with about $26,700 instead of $30,800. So you have $4,000 less cash out of pocket. and their payment's a smidge cheaper because the interest rate happened actually, the loan amount is smaller. That's what it is, not the interest rate, but the loan amount is smaller. So you have a very similar payment. You're coming in with less money. And guess what? This is all assuming that the house had come in $10,000 light. So I'm loaning you $10,000 less money, but you're actually coming in with less dollars out of pocket. It's a great tool to consider. Now, what I'll tell you is the conventional options, this is FHA. The conventional assistance options are nowhere near as aggressive. We can do it with a conventional loan. The one that I'm doing right now that I saved from earlier this month is a conventional loan. The rates aren't as aggressive, so you're definitely paying a greater premium to bump the interest rate on the conventional loan compared to if you didn't use the down payment assistance. But it's not prohibitively higher. It might be a 0.5% higher in interest rate. Again, that's no fun, but when it comes to getting the house of your dreams and you got it at 3.25 or 3.75, like rates are stupid, crazy low right now. So be happy you got the house of your dreams in a competitive market like we're in right now is one way of looking at it. And so conventional can be done. Remember, conventional, the loan limit for these down payment assistance loans is the normal national limit of $510,000. Even though in certain counties we can go above that threshold, the down payment assistance loans will not. So FHA is up to the FHA limit within the county, or 510,000, whichever is lower. Conventional is capped at 510,000 for down payment assistance. So guys, my goal here was to just give you some food for thought. This isn't necessarily the right solution for everybody, but I think it's going to open up some conversations as you have buyers that are getting super aggressive in finding a way to win the offer. Definitely reach out to me and talk to me about, Mark will get to your statement in a second. Definitely reach out to me to talk about shortening contingencies and timeframes. I've got a jumbo deal right now that we had a 10-day appraisal contingency, 15-day loan contingency, and a 25-day close, and we're gonna hit all the dates on a jumbo deal, like a $1.2 million deal out of San Jose. So we're getting stuff done and we're moving quick on it. So we would love to take care of you. Mark, your question, why not use this tool, especially a 3% program, even with appraisal at value? I don't disagree. The issue is your cost is higher. So you're definitely, it depends on where the rate market is. So we just looked at interest rates, and interest rates just in the last couple of days have come down super, super low, and on normal FHA. So depending upon the market and the timing, the delta or the difference between doing the FHA loan without the down payment grant and doing it with the down payment grant can be a bigger spread, but it's definitely something that we should be talking to all of your buyers about to see if it makes sense. The other negative about why we shouldn't do this for everybody is it kind of is an albatross around your neck for the next 3 years, because you have to keep this mortgage for 3 years. If you sell, which you probably don't plan on selling, but if you refinance in the next 3 years, you have to pay back that money. And so is it a great option when you need it? Absolutely. But the way things are looking, we could theoretically see rates even better next year. And this would prevent that person from being able to take advantage of those rates unless they were willing to write a check to pay off that 3 or 4% grants. So that's the other side of the coin that I want you to be fully aware of when it comes to full disclosure of what your pros and cons are of using this option. But definitely when you're in a situation where you came up short and it's the only way to make the deal work, this is a fantastic solution. And the big thing I want you to remember, no more requirement for first-time homebuyer, no more requirement for maximum income amount. In other words, you don't have a threshold for how much you can earn. Those are the two big challenges that prevented people from using down payment assistance in the past. All right, gang, that pretty much wraps up my presentation. I'm not going to try and find my PowerPoint again to show you the Q&A, but we're about 5 minutes short of my 30 minutes that I promised, and I'd rather be early than late. Just like my closings. When I close your deals, I'd rather be early than late. Don't you love it? I do. All right, Elizabeth, can you remove the PMI on FHA loan years down the road when over 20% equity? That is a fantastic question, and the answer is maybe. Here's FHA's rule. FHA's rule says if you put 10% or more down, now technically I'm not sure if it's 10% or more than 10. So when you write it 10%, I'm not sure which side of the rule this falls under. But the bottom line is that if you're greater than 10% down, then you have to keep the mortgage insurance for 11 years. Yes, that is the good news. If you're greater than 10% down, you can get rid of it in as soon as 11 years. The bad news, if you are less than 10% down, remember, I'm not answering the question of what if you're exactly at 10% down. I can't remember which side that falls on. But if you are less than 10% down, then you have to keep the mortgage insurance for the life of the loan. So that is the catch-22 on FHA, but you saw FHA's interest rates are so much cheaper. And so there's times when I've talked to people about, doing an FHA loan when it's kind of a toss-up where you could go FHA or you could go conventional. And they say, yeah, but I don't want to pay mortgage insurance. I said, yeah, but don't focus too much on the mortgage insurance piece. Look at your total payment and your total investment out of pocket. And that's a big part of where this tool comes into play, because I look at how much interest and mortgage insurance you pay over time. And I can stretch this time frame out for whatever you want. If you want to see a 15 or a 20 or a 30-year horizon, I can look at a short term, 5 years, and a long-term horizon to say, what's this going to cost you in the long run? Because that's really what matters, is how long are you going to keep the mortgage and what is your total cost, not just what's your best interest rate and not just how do I get rid of mortgage insurance, but what's the big picture best option. And that's where this total cost analysis comes into play. And we will deliver this to every one of your buyers that you refer to me to get pre-approved to purchase a home. Today only, before noon, I'm totally kidding, any day, anytime, I'll take care of you. All right, guys, if you have any other questions, feel free to post them onto Zoom chat or Facebook chat. Otherwise, I'll hang out here for a quick minute and then I will disappear and get on to taking care of your buyers that you've referred to me to get pre-approved. So have an absolutely amazing Monday and we'll talk to y'all soon. Bye-bye. Thanks, Mark. Thank you, Michelle.